Hello, everyone. Hope all is well. I hope the earlier financial modeling sessions were a help for all of you. Now, we are going to be doing a series on international standards on auditing. And basically, we are going to be reading and understanding the ISAs, what they stand for, and how you can basically understand what goes on in an audit of financial statements. So, the first ISA or International Standard on Auditing we have is ISA 200, which is sort of the building block or the foundation for the whole other areas you will study in your other sessions. So basically, the International Standard on Audit will basically help us in understanding how you can audit our financial statements, what goes on in an audit of financial statements, and this standard will tell you how to basically make an understanding of the audit and the different components of an audit so that when we go into the detailed standards, this will be sort of uh, your decision tree or your benchmark type situation. Excuse me. Okay, so let's start. So the first thing we have to do is the scope of the ISA. What does this ISA actually stand for? So that is the most important area. Okay. Okay. So what does this standard define you? It defines the independent auditor's overall responsibilities. Okay. Their overall responsibilities in auditing the financial statements under the ISAs. Now, what do you mean by overall? What an auditor has to do? Okay. Set the objective of the auditor and explains the nature and scope of the audits. Details the scope, authority, and structure of the ISAs. Okay. So this is important. Scope, authority, and structure, including the obligation to comply them. ISAs primarily address financial statements audits. We're going to come to this in a little while, but can be adapted for the historical financial information and highlights the auditor's responsibility to comply with additional legal, regulatory, or professional obligations. Okay. 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 Now, I just wanted to basically go to what the definition of an auditor is. Okay. Okay. Auditor and some other definitions. So what is the premise of audit responsibilities, right? What do you mean by the premise? The basis, the foundation of an audit relying on management and governance to prepare financial statements in accordance with the applicable framework. Okay. Applicable framework can be your, an example can be your IFRS. Okay. There can be others, but IFRS is a very common example. Okay. Ensure effective internal controls to prevent material misstatement. Right. Now, basically, and provide the auditor with access to relevant records. Okay. Additional requested information and personnel. Now, if you look over here, you have to rely on the management and governance. Governance are the directors. Okay. What do you mean by relying on them? So relying means that you as an auditor will be ensured by the management that these three areas, right? Internal controls are there, it's not that fraudulent, right? There is access to relevant records, and they prepare the financial statements, right? Then you will check these financial statements. You will not prepare something and then check it again. Obviously, that will be a conflict. Now, what are those charged with governance? These are the directors usually, right? Usually the board of directors, BODs. Okay. Individuals or groups responsible for overseeing the entity's strategic direction, financial accountability, and reporting processes. Okay. So this is usually what the board of directors does. May include board members, trustees, in some cases, executive management in smaller entities. Okay. Sounds good. Now, definition of an auditor, right? Who's an auditor? The one who does the audit, right? So it is the professional or the professionals performing the audit, typically the engagement partner or the audit team. In some cases, it may refer to the firm conducting the audit, public sector entity, including terms of class. So basically, what do you mean by the professional performing the audit, right? So an audit, typical audit firm structure, right, is something like, you have a partner over here, then you have your team. This engagement partner is the one who's responsible for the audit. They will sign the audit report. They are the one ultimately responsible, but the audit team and the are the ones who do the work, and ultimately there is an entire hierarchy. Okay. So what are financial statements? You already understand and know this, but I'm just going to quickly go. Financial statements are reports summarizing entities' financial condition. These include balance sheets, income statements, disclosures, right? So balance sheets or the statement of basically your statement of affairs. Income statement can also be the statement of comprehensive income, and disclosures, which are the notes to the financial statements. So they are snapshot of financial position at a time, performance over a period. Income statements can be for a quarter, can be for 6 months, 1 year. Disclosures, right? And usually an audit, it is a 1 year period. Explanatory notes, these may be cross-referenced, provided this is allowed by the reporting framework. Historical financial information, this is a definition. Financial data from the past expressed in monetary terms. Historical, okay? Similar to the historical cost concept, in which you were taking the old cost for an asset. Same. The idea is that you are auditing the old information. You are auditing the future, right? Derived from entities' accounting records. They reflect past transactions. Is the keyword past conditions or events. Okay. Now you have this scope you've done. Purpose of the audit. Now, why would you go through all of this to audit a financial statement? Okay. This is the most important thing. See, I am doing a business in silo. Now, I ask someone to put money in my business. Either the person knows me very well, but for large business, that is not the case. So, how can you basically instill the confidence that I am doing the business to the best of the ability with the best of intentions? Okay, so to enhance the confidence, you do an audit, and then obviously it confirms that the financial statements are prepared in accordance with an applicable financial reporting. Okay. 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 Now, what is an applicable financial reporting framework? It is a set of accounting principles and requirements adopted by management to prepare financial statements. Framework must suit the nature of the entity, objectives, and comply with legal requirements. There are two types: fair presentation framework, right? Recognizing the management may need to make additional disclosures or deviate from the framework rules to achieve fair presentation. Compliance framework requires strict adherence to the rules without flexibility or deviations, additional disclosure beyond what is specified. So, you know, fair presentation framework, management may need to be a little flexible or may need to deviate to give a better presentation. Compliance framework, you follow as is. Scope of the audit. Audits evaluate whether financial statements are fairly presented or give a true and fair view. Okay. Now I'm going to quickly show you an example. Just give me a minute. Focus is limited to the financial statement prep, not assessing future viability or management efficiency. Okay. You're not saying that today this company's product is this, tomorrow it will go up. Okay. No, you're not doing any predictions or anything. You're just talking about what the financial data tells you. Okay. Now, let me just quickly additional of opinions internal control may require extra procedure based on jurisdictional. So that is a separate issue. Now let me show you the importance of an audit. I'm just going to quickly share the screen again, change the screen. Okay. Now, for example, let's go to Google and type in NVIDIA stock. Okay. Now, if I see the year-to-date trend on Yahoo Finance, I can see that on January, NVIDIA stock was valued at $48. Today, in 1 year, it is $135. Okay. It's a little low. If I see how the price has risen from 50 or $48 to this, or in a 5 year trend, you will see that it used to be $8, $10, $20, whatever. And then immediately in 5 years, it has sprung up to $135, right? Right now, this is the price. And it's saying it has grown up by 2,312%. Now, what does this signify? This signifies that this company is doing something, which is why the price is going up and investors are believing that, this company will do something well. Now imagine for a while, obviously this is NVIDIA, is one of the largest companies in the world. If, you know, this information was not right, then obviously investors would be losing money. They would believe that the price is going up, the company is going to do great things. And imagine that this company closes down. Obviously that will be a very, very, very negative for the whole market. So if I go to the financials right now, okay, all of this financial information, this is fine. The management is giving you, right? If I go to NVIDIA, I'm just going to show you. Okay. So this is the investor relations page. Okay. Let's read the annual report right now. Okay, I'm opening the annual report. Okay. I'm not going to be going through the whole thing. They're just telling you what they do, AI, future, and everything. But if I go down, if I go down, so these are the financial statements of NVIDIA. Okay. If I look at over here, I will see that the revenue has more than doubled. January 20th, 2024 was 61 billion, and last year it was 27 billion. So obviously the revenue has doubled. Huge amount of revenue rise. Now, how can you be so sure that this revenue rise is genuine? So if you see, this is the audit report. Obviously, it's under the US standards, but you will see that every annual report of a listed company has an audit report, right? If I go down, report of registered, da 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 da, you will see that this is Price Waterhouse Coopers, PwC, one of the largest audit firms in the world, right? And they are basically giving you some form of assurance that, hey, whatever they are reporting looks to be true. Okay. So this is basically your crux of why you do an audit, because it enhances the user's confidence in the data and in the financial statements. Okay. Now let's go back to our area. Okay. Excuse me. So as I had said, that the premise was that management will make the financials. You as an auditor will basically audit it and see, if it looks reasonably okay. So management, who's management? You're not the management. You are the person doing the audit. Individuals responsible for the day-to-day operations and decision making of the entity. In some cases, management may include members of the governance, such as owner, managers, or executive board members. Basically, the management of the company. Nothing. I don't think so. There is any difficulty in this one. Misstatement, any difference? Okay, so this is important. It is a difference between the reported financial data and the requirements of the applicable financial reporting framework. Right now, for simplicity's sake, it is simply A minus B. Okay. Now I'll just show you how. For example, your depreciation expense, your depreciation expense should have been, let's just say, should have been 1 million. Okay. You accidentally calculated it as zero point 0.8 million, 0.8 million. Okay. So you have a difference of 0.2 million. Okay. Now, what does this mean? that this is some sort of an error. Now, this is a misstatement, right? Now, either this is the issue that either the misstatement can occur due to error, you made a mistake, unintentional mistakes in data or reporting, or you committed a fraud, which we will see later on down the line, that you intentionally wanted to mislead people into believing that the numbers are, what they are. So fraud will have the difference of an intention. We'll see this later on down the line. But any misstatement can occur that, hey, you made a genuine mistake or you wanted to basically mislead your user of the financial statement. Right. So what does the management will do? They will review the financial statement in line with the applicable financial reporting framework. They will establish internal controls, right, to ensure financial statements are free from material misstatement, right? Obviously, internal controls will always, never work 100%, but still provide the auditor with access to relevant information, documentation, and personnel. Framework identification. Identify and adhere to the applicable financial reporting framework based on laws or regulations. Ensure the framework includes appropriate principles of policy selection and estimates. Types of financial reporting framework: general purpose for a broad range, example IFRS; special purpose for specific uses. Okay. Yeah, general points, nothing, right? We already studied this components of financial statements: balance sheet, income statement, cash flow, change, equity notes. Some frameworks allow single financial statement with their notes as a complete set. Special considerations: ISA 210, ISA 800 provide guidance on framework acceptability and special purpose considerations. Public sector audits may have additional requirements related to law, regulation, and compliance. Okay, now let's just quickly see that these were the basics of your audit standards. Now, based on these audit standards, there is some other detailed area which we will discuss in our additional session. Okay, so this was session 1 of ISA 200. So thank you for this, and we will continue this in the next session. Thank you.